Our next guest is hesitant to take more rate hikes completely off of the table. Former Barclays CEO Bob Diamond, now CEO, founding partner of Atlas Merchant Capital, is here at Post 9. We're lucky to have you, Bob. Welcome. Good to see you.
Good to see you, Carl.
To the degree yesterday was a re-rate, was it deserved, do you think?
Yeah, I think so. I mean, I think we felt there was little chance for another raise in December. There's one more FOMC meeting this year in December. I think it completely took it off the table for now, and I think we can look toward next year. We're in a pause. Our sense is that the Fed is pretty pleased, given that, as recently as March 22, it's hard to believe, right? 18 months ago, they were still buying $120 billion in treasuries and mortgages a month. They clearly waited too long. The first rate increase was 15 months ago, and I think it was June or July 2022. 550 basis points, unprecedented. And yet the economy is moving forward, and frankly, the bond and equity markets are kind of in balance. And I think one of the things I discovered as I was in Asia a couple of weeks ago and in the Middle East last week, and the perspective of what's happened in the U.S. In this correction phase is like, did they really just pull this off? Did they really raise rates 550 basis points, begin taming inflation? The economy is not in recession. The markets are balanced. And I think sometimes we don't take the look that people from outside the U.S. have, which is, yes, they waited too long. Yes, we had too much stimulus. But this is a pretty good result. And I think the Fed is sitting there feeling pretty good right now. They'll definitely err on the side of waiting too long, I think, rather than getting out. So
you don't see rate hikes next year?
Boy, David, I think I hate to say anything zero, but if you go through Fed history, the barrier for them to reverse course versus pause is very, very high. So barring something systemic, I think they're going to wait quite a while before they even contemplate rate cuts. Yeah.
Meantime, Wells today, they're still pretty cautious on equities. We feel there is a significant post-QE rot in many bond portfolios, i.e. unrealized losses, which still make for an unstable foundation. Fair?
I think so. I mean, if you just look at the banks, right? We talked about SVB and the 10 years versus the deposits and the flight of deposits. The mark-to-market on the banking industry for their treasury portfolios, what was the negative mark-to-market if it went through the P&L, was $600 billion. B of A alone was $100 billion. I think JP Morgan was 30 or 35. So you don't have 550 basis point increase in rates without having some damage in treasury portfolios, because they can't be short, right? So they have to be somewhat long. We'll have to work through that. And I think it's very fair, Carl, to say that overhangs the bond markets to some extent. I don't think it's a huge barrier, but it has to be considered.
I think Sarah has a question.
Bob, what about it's Sarah in Vegas. Hey, what about the overhang of just the sheer amount of Treasury issuance that has to happen going into next year? I know it helps to have lower interest rates, but they're still a lot higher than they have been, and there's questions about demand and who's going to absorb all this debt.
Listen, for all those positives we just talked about, the stimulus in the beginning of COVID was spot on, but we've had some big whiffs. The Fed waited too long, and as Stan Druckenmiller pointed out, a few weeks ago, they did nothing about extending duration, and I think that was a big whiff. So I think the dark cloud hanging over us is debt. From the time Trump took office, so 7 years, the debt's gone from $20 trillion to $34 trillion. The bill this year, I think the fiscal year ends 9/30, $570 billion in interest costs, and rates weren't all the way up. And so as we look forward, I think the big dark cloud overhanging us, Sarah, is the debt pile, and how we're gonna manage that over the next few years.
Yeah.